So what do gold and copper have in common? Not much. And that's what makes the copper-gold ratio a very useful tool for intelligent investors. There's a not well-known indicator called the copper-gold ratio that could be signaling exactly where gold prices are heading next. And by the end of this video, I'll show you why this simple ratio might be your best friend if you want to stay ahead of the market. The copper-gold ratio is simply just the price of copper divided by the price of gold. It's different from the gold-silver ratio I discussed in my previous video. It's the other way around. I'll link that up and you can watch that. I really recommend watching that once you finish this video. Plus it helps my watch time because it's a very small channel that YouTube isn't promoting this at all. So copper, for those who don't know, is basically like a metal with a PhD in economics. It's commonly referred to as Dr. Copper, and for very good reason. See, copper is a very heavily used industrial metal, unlike gold, which is mostly used for just a storage of gold. Yes, in jewelry, and yes, in some industrial applications, but mostly it's a financial store of value. People don't usually buy copper bullions. People don't generally buy vaults and stack it with copper thinking it's going to rise, right? Although it is quite fun to buy them. Gold is much more of a traditional store of value. Gold is the safe haven that many people run to when the markets get risky, and this has historically always been the case. Watching the copper-gold ratio is basically like watching a tug of war between growth and fear. As of now, the ratio is quite low. So it's potentially a flashing sign of economic caution, which is good for gold, by the way. And as you can see, gold in the recent charts is starting to break out. The markets haven't opened yet, but we'll see what happens. I'll probably report that on the next video, most likely, depending. Although my gold news videos don't seem to get any views. Back to the video. Why the copper-gold ratio matters for gold. In terms of economic signals, a rising ratio means that investors are betting on growth. As you know, it's very important to understand not just what the market is doing, but what the market thinks is going to happen. So when investors are betting on growth, this often precedes rising bond yields. Conversely, a falling ratio suggests economic worry, which is really good for gold. Now, there's a connection between the 10-year US Treasury yield. The copper-gold ratio historically has shown a very strong correlation with the 10-year US Treasury yields, meaning in theory it can help predict interest rate moves before the Fed even says anything. This is quite a big deal. You're getting really good gems in this video, but YouTube's not promoting it, so this is very useful stuff. Anyway, I digress. So in 2025, nearly the end of August, nearly the end of winter in Australia, the ratio is doing what it does best and behaving like a market mood meter. With inflation, the Fed policy, uncertainty, and uneven industrial demand all swirling, copper and gold seem to be diverging rapidly, which makes this very revealing right now, since the copper-gold ratio is falling. Does that mean that gold is about to rally hard? Well, this is not financial advice, and of course I can be wrong, I'm only human, but it looks like, from my analysis of the charts, that gold is likely to break out, probably do a break and retest, then break out at some point. I wasn't sure when gold was going to do its breakout, but it seems to be, it's about to start. Quite hard to say 100%, but gold seems to be doing well at the moment based on the macroeconomic data I've analyzed excessively. But even so, the gold-copper ratio at the moment is suggesting maybe something larger is at play, like a structural slowdown, or maybe a bond yield drop, who knows?